crowdfunding.
Hey everyone, so Pastor from the family, and I have the privilege of interviewing 3 very cool guests, which you will soon be able to interact with as well. So I hope you enjoyed the event with Fred and Balthazar. I didn't get to see the end, unfortunately, so I'll make sure to watch the replay. But the idea was to bounce off the content that was there and to sort of talk about other sources of funding and how they might have been impacted by the crisis. And so to do that, we've invited 3 guests. So Azahara works at Crowdcube, a very famous crowdfunding funding platform. Bertrand works at ConsciousGrowth, which provides startups of different shapes and forms with non-dilutive funding, so through a form of fixed rate debt, which I'll talk about. And then finally, Thibaut is actually a founder that used to, and is now running a company that's one of the family's portfolio companies called Fairmint, and a financing solution called CSOs, which he is much better suited to explain than I am. And so maybe to start off the conversation, I'll have the 3 of you describe what your different solutions are, and then we'll dig into how they differ from more traditional sources of funding and how they've been impacted by the crisis. Maybe Thibaut, you can start.
Yeah, sure. So hi everyone. So my name is Thibaut. I'm the CEO of Fairmint. So yes, I've been as Matthias said, I've been an entrepreneur for like more than 10 years now. So I had a B2C company, raised funds. After that, I became indeed partner of the family to help entrepreneurs. And all those experiences confirm just one thing: that fundraising sucks. And this is why then I started being on a quest on solving this problem and solving how do you finance your growth when you're an entrepreneur. And this is why we created Fairmint. And Fairmint allows entrepreneurs to receive financing basically from anyone in the world who support your product and mission at any single time. So there's no campaign or anything. And you receive financing at public market valuation. So it's great. It's non-dilutive. So yeah, and coincidentally, we just opened, we launched today. So if you're interested, happy to talk after, but I'll let the other introduce themselves.
Yep. So I work for Crowdcube. We are an equity crowdfunding platform. We are based in the UK, although we have also an office here in Barcelona, where I'm based. I've been working here since 2014, and I think we were created in a very similar way as Thibaut was mentioning. They were created because we were also trying to tackle the many different problems that entrepreneurs were facing. So basically what we do is that we work with companies looking for investment. We offer them a platform through which they can do public international campaigns, not only reaching our community of investors registered in the platform, but also being able to invite their own community of customers. So they are able to do a fast and legally structured way to raise finance. And on the investor side, we basically allow people to invest from as little as 10 euros. So our aim is to be able to democratize investment also on that way. So at the moment, we've worked with more than 1,000 different campaigns, reaching investment for over 800 millions. So yeah, we are doing well, and we are really happy because we were only working with UK companies previously, but now we are open to the whole European market. So we are working a lot now.
To finish off the introductions, maybe Bertrand, you can tell us a bit about both yourself and ConsciousGrowth.
Sure, thanks a lot. So I'm Bertrand. I'm in charge of sales and account management at ConsciousGrowth, which I joined as first employee back in August 2019. After a few years working for Credit Agricole Investment Bank back in London. So what do we do at ConsciousGrowth? Well, we're building the first conscious entrepreneurship bank with a vision to incentivize conscious entrepreneurship via next generation financial products. And with funder-friendly revenue-based financing as our first application, what we are trying to achieve is pretty much empower entrepreneurs to be more in control of their company, and by extension, allowing them to be more autonomous, grow on their own terms, and ultimately align their business with their values. So just a few words on what it means in practice, how our financing work. Well, today, currently, there are mainly two traditional options to fund the growth of your company, namely equity and debt. And we all know the main downsides of both. I mean, it's been mentioned by the Thibaut and all the funders, including. It's not ideal in a certain scenario. So what we've done at Conscious Growth is build a process and a product allowing funders to first, within a few days, receive a financing offer that will dynamically match the growth of the company and the related funding requirements over time. Second, we allow them to keep control and ownership. So, we don't ask for equity, we don't ask for board seats, nor do we ask for personal guarantees. And the third part is we allow them to repay the loan based on company's future revenue, which not only limits the financial burden of fixed interest payments every month, but also fully aligns all stakeholders' interests towards the growth of the company. So yeah, very excited to be part of this panel and discuss further alternative financings.
Cool. So I have a small list of questions. If you have questions during the conversation, feel free to put them in the chats, and I'll try to include them as we go as much as possible. And if not, I'll take them towards the end. So one of the first things that I want to bring up, despite the fact that this panel was called Alternatives to VC Funding, is that actually, at least in the case of Bertrand and Azahara, or more precisely Conscious Growth and Crowdcube, it seems like a lot of the companies see your financing as a complement. There's something that goes alongside VC funding. And so I was wondering if you could tell us a bit about how you see this, so these sort of hybrid sources of financing, or whether you think that ultimately the idea is to go for either full crowdfunding or full sort of conscious capital on the other hand. Maybe Azahara, you can start, because I know that you have some landmark cases with Monzo and then some others that are fully crowdfunded.
Yeah. So yeah, as you mentioned, most of our biggest success stories are actually companies that have co-founded by VC and also what we call the crowd. And we've actually seen like some changes in the way VCs see this, because before it used to be the company, the one proposing the VC what they wanted to do. So for example, the case of Monzo, I think it was the first campaign. They did a raise that was like 6 million, and they were talking to VCs, and the VCs were of course like happy to be investing the 6 million, full 6 million on them. But it was them the one seeing a very big added value on leaving a small percentage of this equity crowdfunding campaign for their crowd. In this case, it was 1 million with their first campaign. So what they did is that they launched this campaign in which they invited their own customers to invest alongside, in this case, it was Passion Capital. And they did a very big success case, because they actually, with the numbers that they are showing at the moment, they were able to prove how inviting your own customers and turning them into investors can add value in the long term. These investors are going to be the ones recommending you more. These investors are going to be the ones using your product more, using your service more. And this is something that the VCs have been seeing during the last years. So at the moment, we have a lot of companies that maybe first go to the VCs and they try to get the investment from them, because at the end of the day, I think we can't deny that VCs offer an added value, a big added value, especially for some companies. And it's actually these VCs, the one telling the company, have you thought about doing a part of this campaign through the crowd, through your own community? Because for the VCs, at the end of the day, this is also a market validation. I mean, if these companies manages to get 2,000 customers investing in their company, it's because they're probably doing very well and because their customers believe in them. So at the moment, as I mentioned, our biggest success cases are especially the ones that manage to get the added value from both sources. The VC, business angels, in some cases is even industrial investors, and on the other side is the customers as well. And this is something that the VCs are seeing.
Bertrand, in your case, it's interesting because one of the big differences in your sort of financing solution versus others is that you don't necessarily take the same warrants as traditional lenders would. And often people who are lending to startups wanted to see big VCs in the company because the money that was put up as equity sometimes served as the collateral to pay back the loans. And in your case, that's not exactly how it works. So I was wondering if you could tell us a bit about, one, how it works as a business, because there was a reason that the lenders decided to consider the equity, and the other, if you still push people to bring VCs on board.
Yeah, I mean, just a few points on, what is the approach to funding your company? Well, first, depending on where your company stands, your business plan objective will vary, and so will the related funding requirements. And so the people and institutions you will talk to when it comes to raising money will be different, whether you're working on a potential ID or whether you're implementing a strategy to scaling your existing product line. So all in all, depending on the stage you're at, some funding options will be more or less available than others, but also will more or less optimal than others. And in our case, what we do, we don't position ourselves as a complete alternative to VC, not at all. As you rightfully pointed out, we're more financial nudge, like a complementary addition to VCs whenever it comes to scale and achieve further growth. For us, we've built a model that is purely data-driven, where we want to understand what is the growth strategy of the company. And I could maybe expand later on the ins and out of the whole process and product. But we take a very narrow focus on what's the growth strategy and what's the potential for growth. And based on that, if your unit economics are good, and there's a clear path to growth, then we are comfortable providing you with growth capital using revenue-based financing and this multiple progressive tranching system that will allow the companies to have a clear view of what it means to be financed through their whole growth journey.
Thibaut, so you're probably the solution with a more radical take on this. And so I was wondering if you could tell us a bit, when you're talking with your prospects, what you suggest, if you should go for more hybrid sources of financing, or if you think that the CSO can, right from the beginning, be sort of the alpha and omega of financing.
So CSO, so first off, a CSO stands for like continuous securities offering. So that means that unlike when you do like a traditional fundraising, where basically at one point you stop focusing on your business and you start focusing on VCs to try to go and get financing. Here, what a CSO enables you to do is just to put this invest now button on your website. And like this, your CSO can run for 5 years, 10 years. And at any single time, people who want to invest can come, click on this invest button and invest in your company. The way it works is we don't work with equity. So we're totally compatible with any source of financing that works based on equity. The way it works is really simple. Is as a company, you're going to say, well, look, I'm going to put 10% of all my future revenue up to 5 years, let's say, on the market. And you let people basically buy a stake on, like, speculate on those future, what those futures revenues are. So it's really based on saying, well, you know what, I have this company, it's starting to grow, I make some revenues, and like my customers are delighted, I love my partners, and basically you want to like bind all your community, your stakeholders together so that you can grow your company and be extremely stable. So CSO enables you to do that. And what's great for entrepreneurs is that, yeah, like it's completely, you don't have to go and pitch investors. You can stay focused on pitching customers. It's much better. It's non-dilutive. So you keep full control, full ownership of your company. You keep focused on your long-term vision and achieving your long-term vision. And you don't have to be a fundraiser. Like basically you let the numbers speak. Like the fundraising process right now is very biased towards if you're a white guy, well educated, if you know how to speak well, if you know how to speak to financial people, well, you're way ahead of the curve. And here with the CSO is like, no, like people just look unbiasedly at your numbers. Like, are you able to build a good business? If you're able to build a good business, then you can they can invest. And I can ask actually the audience, like right now, I'm sure you're using tons of products, tons of services online, like Hopin. I contacted Hopin because I would like to invest in Hopin. This thing is really good. It's really good. It's a nice piece of software. And I can't. I wish I could. Now I need to wait until they IPO. But when they IPO, it's not a good deal anymore. So yeah, CSO enables you to do just that. And so yeah, please, if you want me to contact companies to do a CSO, please put them on the chat, like the ones you'd like to invest, and we'll reach out.
So that actually brings me back to another point, which is one of the relative sort of reasons that VCs are attractive is that if you're only raising from them, the cap table can be quite clean. And so you have a couple names, etc. And at least I remember that in the early days of crowdfunding, that was saying like, the day that somebody wants to buy you, it's going to be awful. And CSOs, people say that the companies are worth what their future cash flows are. In case you're changing what the future discounted cash flows are, so you're making it a bit harder to value what the company is. And so I was wondering if you could tell us a bit more about that aspect of how you see the financing.
So VC sees they see a CSO like a crowdfunding venture debt. It's really what it is, like from a VC's perspective. I mean, it's leverage. It's non-dilutive capital that enables VC to get and investors to get more leverage. And at any single time, how much like the CSO close, because you can close your CSO. And when you close it, exactly the cost how much it's gonna cost you. So actually, if somebody is buying your company, then there's two options. Either your CSO has become a strategic asset of your company because there's all your users, all your customers are incentivized in the success of your company, and so you bind them together through the CSO. In which case, it's very likely that the buyer will not want to close it and just continue it because you can continue your CSO as much as you want. And if the buyer is like, no, I'm not interested in this at all, he has the option to close it. And then to close it, he needs to pay an exit fee. You need to pay an exit fee for to close your CSO. But this exit fee is always known. And so it's just a fixed cost that is predictable.
You're going to give an answer for the crowd.
Yeah, so you're completely right. If you take equity crowdfunding some years ago, I think the cap table was a mess. And it actually was like that. It is still like that in Spain because the legal issue is still the same and it hasn't really changed. But in our case, we are working under UK legislation, and I am aware that some of the European legislation as well is making it way easier. So at the moment, we work with a vehicle, with an investment vehicle. It's an SPV. So when a lot of people invest, you have to take into account that we have some companies that have over 10,000 investors. We ourselves as Crowdcube, we do equity crowdfunding, and we have many thousands of investors in our cap table. However, we are all under the same vehicle. So on our cap table of the company, only Crowdcube appears as an investor, which makes things very easy because at the same time we have a team inside our Crowdcube that manages this conversation or any kind of process that has to be done with investors at the same time. So in a way, and we've got this said by many of the entrepreneurs that we work with, it makes it even easier that sometimes when they get and accept investment from a VC or a business angel, that might be a little bit more complicated. With us, we always tell the entrepreneur that our investors, most of them, are passive investors. They are investors that go into our platform as an equity crowdfunding market where they can find and diversify their portfolio. They invest in many companies, and they are not going to be working on, they are not going to be in the daily lives of every company they invest on. So everything they want to get is some information at the end of the semester about how the company is doing, the company being transparent to them, feeling that they are actually shareholders of this company. But at the end of the day, how these investors are managed is very easy thanks to this vehicle that we call the nominee.
One question by Julien, which is actually the question I wanted to follow up with, because at the end of the day, it's the theme of the event, is how your respective solutions have been impacted by the crisis. So maybe Bertrand, it's also an opportunity to tell us a bit about where the money comes from that you're lending, because obviously the price of money is something that's very uncertain these days, and the price of debt is something that's also quite uncertain. So maybe you can tell us a bit more about that.
I mean, this is a very, strenuously quite unprecedented time, which led to companies, including us. I mean, we're a startup. We're 8 to 9 months old right now, so we've had to take a step back, review, and adjust to whatever the situation was, and how to be able to then adapt and potentially thrive through these new market conditions. First, so from the investment side, what we've seen, and we've seen two sides of the same coin, really. We've had companies with massive decline in sales, but also companies that found their way through and perform relatively well in the past couple of weeks, which means that we're still, I don't like to say open for business, but we still have a significant amount of money to play with, so to speak, during that time, to be able to support companies that do find a way to make it work. And from an investor side, I mean, it is complicated. I mean, we're constantly talking to obviously debt providers, mostly equity providers, for our day-to-day operations. What we've seen so far is just a little slowdown in the discussions that we're having. There's no absolute hard negatives or complete stop in liquidity providing. But it's been obviously, I mean, as Fred from the previous talk pointed it out, people do not necessarily understand, and investors do not necessarily understand today what's going on. So everyone is pretty much taking a step back to get as many information as they can and make relatively smart investments when need be.
You reply. I'd like to add a top-up question. Well, actually, no, reply first, and I'll ask my question after. Maybe Azahara, you can talk about if there's been big changes in big changes in the volumes on Crowdcube on the buy side, on the investor side.
Yeah. It's a very good question, because I think we are still looking at the numbers and analyzing how everything is gonna affect the number of investment received into the platform. And I think it's a really good opportunity also to see how companies are reacting to this, because I think we were anticipating that the number of investment were going to decrease in some cases, especially big tickets of investors that used to invest from 5,000 up to 50,000 in the platform. However, if you take the total amount of investment that we've received, it hasn't really changed that much because of the behavior that the companies are acquiring. In this case, for example, we've just recently have an example of fintech companies raising money this week, and they decided to do a private round. A private round means that they are just going to offer to their own community and just to their own investors. They didn't do it public. And in only 24 hours, like over 3,000 investors invested. At the end of the campaign, it was like 1.9 million invested on them, only with their own investors, current investors, which tells you something very interesting. And it's how investors are reacting when they actually already know the company and when they already believe on them, when they can consider themselves a community. This is very different when you are actually tackling an investor that maybe is just seeing your business plan or has just met you in a one-to-one meeting. These people actually feel themselves part of the community. And I think this time of crisis is when this community not only invest in you because of a rational reason, which they might also do because they know that your service or your product works, but also because of an emotional one. And I think it's something that makes equity crowdfunding very interesting for most of the companies when they mix this rational and emotional reason when it's backed. And I think we're going to be seeing many more of these companies not only using these public crowdfunding campaigns, but also using it to make private ones.
So that's an interesting point, and it actually leads to the topic question I wanted to ask, and maybe Thibaut, you can start answering this one. Is in the cases of both Crowdcube and Fairmint, one of the difficulties is that you don't necessarily know what you're getting upfront. So one of the reasons that the founders will go to VCs is because they have a plan and they say, okay, I need £1 million or 2 million euros or whatever to get to this next milestone. If you're depending on whether it's the success of your CSO or the success of your crowdfunding campaign to reach those milestones, it's a bit more difficult. So I was wondering if how on one hand you manage the expectations of founders, and on the other hand, how you make them sort of think around their planning given this uncertainty.
So it's an interesting question. So indeed, like if your plan as a founder is to say, well, I know my competitor is on sale and I need like 10 million now to be able to buy my competitor, the CSO won't help. That is for sure, because it doesn't provide this certainty of, okay, like there's somebody putting a check and now I have the money in the bank. However, the good thing about a CSO versus VC is that VC, the problem is that every time like you raise money, basically as a founder, I'm talking as a founder, like you push the valuation of your company up, right? And the thing is you can never go down. The moment you go down, like this is where like real shit hits the fan. And so the CSO is much more flexible in this, and people will just look at your growth. Like you make revenue and you make more revenue, you're growing well. And the more you grow, the more you build trust among your investors and the more they're willing to invest. And you have the right of failing. If there's a crisis at one point, well, people stop investing for that moment. But like you keep still, you keep the money in your bank account, and maybe the price of your, because when you create a CSO, you create your own financial instrument. So the price of your financial instrument is going to go down. But the fact that it's going to go down without affecting you leaves more room for upside. So if things go back on track, then you can re-raise funds, and you don't have these crazy like down rounds that just kill entrepreneurs. So it's a very safe way of raising funds.
Azahar, can you tell us a bit about how you manage the expectations and the financial plans, or help founders think about their financial plans when it comes to crowdfunding?
Yeah, so we don't really get into financials that much. It is true that one of the big things in our campaigns is investor forum that we open up into every public campaign that we do. And in there, many of the investors that we have, I mean, you might think that because it's the crowd and because it's crowdfunding, maybe investors don't know that much about financials. But then when you look at the questions that they ask, you realize that most of them are very experimented people that know the numbers, that they've talked to entrepreneurs previously. So most of the financial questions come in there. And we always tell the investor that they have to be as transparent as possible. One of our big success cases in Spain is actually an entrepreneur that used to have a company that actually failed. And he had some bad numbers about that company, and people started asking him about it. And he was so transparent that people actually became a fan of him, saying, well, if this person is so transparent, he has to be transparent also with the new business that he's creating. So in terms of how expectations are managed, we always tell the entrepreneur that it has to be him or her, the one managing these conversations with investors. In the case of valuation, for example, which is like one of the big problems, I think, in the entrepreneurial world, normally if the company comes with a lead investor, VC, business angel, whatever it is, normally the valuation is set with them. And in this case, for example, of crisis, where I think the valuation becomes a little bit more complicated, or even it gives you some problems when you want fast investment, but the valuation is not set yet. We, for example, come up with some new products, such as convertibles, for instance, that we've started to use now. And companies are starting to be using it now. But we never give advice exactly on how to manage these expectations. It's normally the entrepreneur, the one managing this directly with the investor.
Sorry, my question wasn't clear. What I meant was that how do you manage, because you can't guarantee. So if they say I'm going to try and raise 100,000 euros or 250,000 euros with Crowdcube, you can't guarantee that it's going to but maybe they have a plan where that money is included in the plan. So how do you help them manage that?
Okay, so normally when a company comes to us and they tell us, they normally give you a bracket. So they say the minimum I need is this much and the maximum that I will be able to accept is this much. This takes into account, of course, how much equity they will be able to give out to the new investors. Here, under the UK legislation, you can also go overfunding. So basically, when a company works with us and they come with a lead investment, we kind of calculate how much lead investment there is and how much it would be feasible for them to raise under the platform and how much will it be the maximum that they will be willing to accept. So we normally try to get them to raise something that we think is going to be realistic, but at the same time, it has to be a minimum enough for them to accomplish the business plan that they are presenting to the investors. From them onwards, if they raise more and they are willing to accept more and they're willing to give more equity, of course, to the new investors coming up, they can go up to as much as they want. We've had some companies raising up to 3,000% of the amount that they wanted to raise at the beginning. Of course, they have to be aware of what that implies. But yeah, normally we have a whole team of people that have been working with different industry sectors, with different campaigns, and we normally know how much it would be for them being realistic for them to accept, or for them being realistic for them to be able to raise under the platform.
Great, thanks a lot. Bertrand, can you tell us a bit about how you look at the businesses that come to ConsciousGrowth? So you gave some high-level indications, but it'd be cool if you could give us some examples of companies that you think are particularly good fits. And then I'm curious to hear Thibaut's reaction, because I wouldn't be too surprised if there's a good degree of overlap.
Yes. I mean, the way we work, our product and our message is the most appealing to companies that obviously have found product market fit and are on this phase of growth where they just need to capitalize on existing strategies, and that being, investing massively into marketing or inventory. So what we do, the process that we've built, is that we take a complete data-driven approach as to understand what has been the growth strategy, i.e. where did you put your money into marketing, how much revenue has been generated through that. We're looking at different metrics as to understand also what is the potential for growth using the existing channels that you have, so that we come up with an optimal funding offer, which is a combination of loan amount, let's say 100K, and a percentage share of future revenue that will go back for repayments, that will not only allow companies to still materialize that growth, even sharing that percentage of revenue, but being able to repay us within a time frame that we've established. And we keep that logic tranche after tranche, using different KPIs indicators, such as revenue generating, return on advertising spend, for instance, really broad range of performance KPIs that once they materialize, we constantly open the funnel for further financings with different terms. And that's the idea of the financing. The best fit companies, I don't know if you were referencing we're talking about different particular business models or different stage, but as I said, sorry?
Both,
yeah. So in terms of stages, we're not going to finance. We're not going to be the good partner for financing an idea, turning it into a product. Now, whenever it comes to growing, and that's why we're not a competition to VC, so to speak. When it comes to growing, when it comes to invest massively into sales and marketing expenses, which are relatively low risk and quite capital intensive, well, there is a better fit and a more optimal funding source, which should be non-dilutive and should be also easily accessible and in a fast way. So that's in terms of business stages. In terms of industry, we've worked a lot with companies in the e-commerce space, a lot of direct consumer brands, also marketplaces, but we're seeing an increasing amount of discussions with mobile apps, for instance, which are also using online marketing and different customer acquisition strategies that could be financed using revenue-based financing.
Is it roughly the same stage for you guys, or are you sometimes able to go lower?
So for us, like the minimum that is required is that the company has a business model and generates revenue. Because a CSO is based on basically speculating on your company's future revenue, you need to have early revenues. So then, if you have revenues, then we can go from early revenues to pre-IPO. But it's really about like you generate revenue and you have a path to growth. If there's no growth, for example, if you're a coffee shop, it doesn't work. If you do a chain of coffee shop, it can work because like you have a path to growth. In terms of verticals, is really like e-commerce, marketplaces, SaaS businesses, fintech, memberships. And in terms of type of company, I'd say there's like two spectrum. Either like you are really fast-growing company, in which case like you'll attract a lot of investors because your financial product is going to be stellar. Or if you have a lower growth, it can still work if you have like a cult-like community. Like if you have supporters, like customers that really, really love you and wants to support you, it's also a great way. It works very well. And just to be clear also, because as I was pointing about, one of the big friction of fundraising is the valuation, right? Like how much is the valuation at which investors should invest? And I think this is one part where CSO is super interesting, because the way it works, as I said, like you put on the market a fixed fraction of your revenue for over the, let's say, next 5 years, and you ask the market to value that, right? So you're not saying, here's the valuation of this. And what happens is that at the beginning you have a trial period, right? And the trial period, you say, well, as long as I'm in the trial period, everybody can say goodbye. Like I can cancel the CSO, the investors can get their money back, and the trial period finishes once you reach a certain amount of money, like the amount of money that makes you confident that you want to keep going for at least five years at minimum. And then what happens is that, well, people who invest will, by investing, they will buy your financial product, and they will buy it at the price that would set the valuation. And the key thing is that every time there's a new financial product that is being issued, and this is completely automatic, like the valuation rises a little bit. And so the more you have people investing in your company, like the more the valuation rises. So this is why like you really raise at public market price. Maybe when on year one, people like evaluate, you put 10% of your revenue, they evaluate it, I don't know, at 5 million. But on year two, like you have had a good growth, and so they can start valuating it at 15 million. Well, from that 5 million to that 15 million, it's money that you got in the bank. So every time your valuation, the market deems your valuation can rise, that's more money for you. This is why like it's really continuous fundraising. You permanently ask the market to value how much 10% of your revenue is worth. So you don't have this friction about what valuation am I worth?
Mm-hmm.
That was actually one of the questions that Jérôme had for you earlier, Azara. So you mentioned that when there's a lead investor, you just follow whatever terms the lead investor negotiated with the company. But what about the cases when the majority of the round is done by you guys?
Mm-hmm. So it's one of the first questions that we get from entrepreneurs who sets evaluation. We never do. We never tell the company how much their value. It's normally the ones giving us an idea. As you mentioned, when it's a lead investor, it's really easy. When they are just expecting to raise money from their own community, it's a little bit more difficult. This happens especially with companies in the beer sectors, restaurants. Breweries is a big thing. I mean, we had like hundreds of breweries raising money in the company, in Crowdcube. And they normally want to raise money just from their own community because people working in breweries are pretty special and they want to keep the control. And they don't want people coming into their company and telling them what to do. So it's some of the sectors that they want to raise money only from their own community. And if you check the valuation of all of them, it's something very interesting to see because it's them, the one setting it. The funny thing is that for most cases, they might have like a family member that it's going to invest like a big ticket or something like that. So they have to set the valuation sometimes inside their own family or inside their own group of friends, which tells you a lot about that valuation because they can't be lying to them. So it has to be something that they can justify. And this is the first advice that we give them. you cannot just say a number. It has to be something that if you sit face to face with your father, it has to be something that you can justify to him. So this is the way we do it. We, of course, have like some examples that have previously raised money with us, companies in the same sector, and companies in the same stages. So we can give them an idea. We can say, this company raised under this money, and at that time they had like 5 years of this much revenue or whatever. So they can have an idea of if that's going to look high or low for the investors, and then they can make a decision out of that. But we never set the valuation. It's always them.
Okay, so you never set the valuation, you never set the terms, and they just follow whatever you're given.
I like that. Like ask if it was your father, would you value your company like this? This is very cool.
Exactly. I mean, at the end of the day, you have to take into consideration your own family. And I always say the same example. Like my father, for example, he's never invested in a company in his life. And when I offered him the first brewery that we were fundraising in Spain, he invested in that brewery. And now every time he comes to Barcelona, he always goes to that brewery. He always recommends that brewery to his friends. So he's a big example. You have to check what your fathers are doing. I mean, your fathers and mothers, of course. I mean, we are trying to increase the number of women investing as well.
So that's actually one of the things that struck me preparation call. Is so a lot of people say that there's added value in VC. So one is sometimes these people have great experience, and so that's valuable. The other is that when you're trying to hire, having a big name VC makes it easier to attract talent, because if you're a small startup at the beginning, nobody knows you really, but they might have heard of the big firm, and so it's nice to have a big firm attached to your name. And then in the same way, you were mentioning that the consumer behavior changed a lot once people became invested in the company. And so I was wondering if you could tell us a bit about that as well.
Myself? Yep. Yeah, so consumer behavior, I mean, if at some point there is a degree in university talking about equity crowdfunding, there will be a psychology subject inside that tells you about consumer behavior for sure. We have the first numbers that we've been getting from the fintech companies raising money through Crowdcube, and they're amazing. I mean, you can see that they are way more faithful, way more committed, recommending 30% more to their friends, using their product, their service. I mean, they are people that if you offer them an alternative, they will never go to the alternative because they are an investor in this company. So why would they go to an alternative company? And this is one of the things that we always tell the companies with a big community, that it's especially our added value. You can see that with our own office. And this same brewery I was telling you about, I mean, they are a small brewery here in Barcelona. Every time we have to celebrate the birthday, we go there. If you have that example, imagine if you extrapolate that to, I don't know, the last electric bike company that we fundraised in Belgium, for instance. They are backed by index ventures, and index ventures were the one telling them, you have to fundraise with your own community, because if you fundraise with them, they will never buy another electric bike, because why would they do it? They will go against their own shares. I mean, it wouldn't make any sense. So yeah, I mean, the investor behavior, which is the client behavior in this case, is what changes the most and what we sell as our the biggest added value.
And so Thibaut, a lot of that applies to CSOs obviously as well. I was wondering if you could tell us because like when you hear description, it's non-dilutive, it's continuous, it incentivizes your users to become better evangelists. Like it almost sounds too good to be true. So I was wondering if you could tell us what the downside is. So if you had to make the devil's advocate case.
I'm not trying to do that. What's the downside? No, honestly, because we really, like, we're two entrepreneurs, right? Joris and I, like the two co-founders, we both had our entrepreneurial journeys before. Joris went full debt. I went full fundraising. Like so we really took a good care of creating a model that is really, that's what we want. That's what we would have wanted when we were entrepreneurs in our past experiences. So I guess the main downside is, yeah, maybe this uncertainty, this uncertainty. And the other downside is that, you need to be comfortable with people knowing what your top line is, because you need investors to trust, as it's based on revenue. You need investors to trust that you say the right revenues and that you commit your revenues properly. And so I guess there's if you want to be completely secretive, then it doesn't work. You need to be able to like be okay with your top line, your revenues being disclosed. And another thing is that it's not for all companies. Like if you are like a deep tech company, like if basically the value of your company is in your IP or your users, but you don't generate revenue, meaning like cases where the equity value of your company is completely different, non-correlated to your revenues, then a CSO is definitely not a good tool for you. So I guess that's the main thing. But the good thing like is really like on an investor side, because this is the problem with equity. Equity, the tough part with equity is that it's very liquid. Like when will you get money out of your investment is a very big interrogation point. And the good thing about the CSO is that you know that you're gonna have like short-term liquidity. So because there's a 1-year lockup on, like when you buy a financial product as an investor, there's a 1-year lockup. And after 1 year, like you can decide to sell it. You're not stuck. As we really create a market, you're not stuck and until the company decides to sell or do whatever. So I think, especially in these times of crisis, I think it's good for investors to know that if something happens, if they get married, if they want to buy a car, a house, get a trip, they will be able to sell.
That's a good transition to, I'm sorry if I mispronounced the name, I think it's Seish question, which is how far down the line do you see CSOs and revenue-based financing being the new startup financing norm and also creating impact in communities? So it's true that
you're asking the wrong guy. You're asking the wrong guy because I'm going to go all in. So honestly, I really think like, especially now with the crisis, it's going to like continuous financing. It's just going to be the future. Like it's so much better. So down the road, like in 5 years, I can like, we'll be able to address like companies. Basically what we want is that it's become the norm. You create your company immediately, you create your CSO, just because like, okay, I've created 5 companies now. And every time at the beginning, you have your first user like, I want to invest. Like, okay, you're not going to tell your lawyer, can you prepare papers so that one user wants to invest $100 in my company? No. And then you start having partners and your partner is like, hey, I love what you're doing. Can I invest? No, you don't want your partner to come to your company because you don't want him to have governance rights. So you're like, hey, I love you, but let's just partner. We'll see for the investment later. Here, like, it's like, you know what? You love me, you don't love me. If you want to invest, you can invest. In any case, you don't have governance rights, so it's just money for me. It helps me develop my business. And you invest $100, I'm happy. You invest $1,000, I'm happy. So down the road, I think it's just going to become the norm.
Maybe you can answer that, and then I have a question about the governance right.
Yeah. No, I mean, I agree with Thibault. At least, in terms of crisis, we see that, liquidity has always been an issue for startups. And in terms of crisis, we see that it's even more of an issue than in regular times. I think, we're seeing the rise of alternative financings for the simple reasons that people need to take, at least there is a need to take a different approach to fundraising. Right now, the benchmark has been using the traditional methods without really questioning it as to whether or not it's optimal. And now we are seeing, with the rise of different alternative financing, the need to really think at which stage do you need to raise and who do you need to raise it towards. And so, whether it's going to be, I don't think it's going to be one type of financing that's going to become the norm. I don't think equity is going to disappear either. It's going to be more, what is the optimal arrangement within your cap table that, and depending on which stage you're on, that will yield to the most optimal way and source of funding for companies. And it's going to become a perfect mix of financing throughout the life cycle of the startups, which in my opinion will become the norm as a very efficient cocktail rather than just like one key and one answer for one solution.
So one question about governance for Thibaut, because that's probably something that a lot of the people who are investing more significant amount of money will be concerned with. So obviously, if you're buying 10% or 15% or 20% of a company, you expect to have some say in how it's run. If you're buying 1% of 10% of the revenue, then you probably care a bit less. But how do you see it growing into sort of a substantial bit of the funding if you have this limitation on the impact investors can have on the way the companies run?
Well, so that's actually, there's a very, very clear data point on this. Like the ICO craze that we've witnessed not so long ago, like really showed that investors are perfectly happy to trade governance if they have liquidity. Like governance is really here because investors cannot sell. If they cannot sell, they need to have some sort of say about like control over the company. So to make sure that their investment doesn't just disappear. If tomorrow the investors can get away easily and sell, like why does it need governance? Like and that's actually even better, because the problem with governance is that there are bad VCs out there, right? And there are bad VCs that think that they are better ideas than the founder, and that try to influence the companies. And most of the time, so it's not like there's not 100% horror stories, but like let's say 99% horror stories when VCs who have control try to influence the company, it usually turns out bad. So this is why I think governance is not an issue. People don't want to take decisions. They want others to take decisions. What they want is they want ownership. They want to participate in the financial success. I love Hopin. Hopin, if you hear me, let me invest. I want to invest $1,000 in a Hopin. Yeah, and I don't care how they run it. Like they've done great. They made a great product. Like we're here today. Like they know their shit. So I just want to put some money, and that's what most people want. They don't want to. And then if you're a VC, if you need to allocate a large amount of money, then you invest in equity. You don't invest in a CSO, and then you're happy because you have equity and you have the governance board, like the governance rights.
There was one question by Cedric, which I suspect is directed to Azahara, about how confident you are or how comfortable you are with the allocations being filled, given the crisis and people probably investing a bit less. We touched upon it briefly, but maybe it'd be interesting for you to say a bit more. I don't know how dependent you are on the small tickets to fill the allocations versus the bigger tickets that make a bit more money still.
Yeah, so we've definitely changed the focus that we have of companies. We are especially focused now on community-based companies and also health sector. We've had some investors telling us that they would be especially interested in investing in health tech related companies, especially if they are COVID related as well. So we are looking into those ones. And community-based startups at the end of the day are going to be the ones finding the most added value onto Crowdcube. And I think they are going to be the ones filling the numbers as well. At the end of the day, I think, and we have a very funny example of one company here in Spain. It's a shoe company, and they released a newsletter into all their customers. And the newsletter was called Fuck, just fuck. It was at the beginning of the crisis, like it was like 2 or 3 weeks ago. And they explained what they were going through. I mean, it's a company that was doing, and it's still doing amazingly well. They were selling very well. And I think their medium ticket, the average ticket was around like 70 euros, more or less, or something like that. It was the amount that their shoes cost. So they sent this newsletter saying the struggles that they were going through, what the obstacles were. And they got such a great reply from their customers that people were buying more into their website after they received that. So if you think about it, why would these people be buying into their shoes and not investing on them if they could invest exactly the same and become become shareholders and not only receiving the shoes. So it's these kind of companies that we want to work with, and it's these kind of companies that will still get the investment that they are looking for from their community when they do these kind of rounds. So I believe, and I'm completely honest with this, I think there will be some companies that will maybe before the COVID will have finance through the platform and will in this case not get finance, but I think we are going to get some knocks on our doors of companies that will have never thought about equity crowdfunding and that are now thinking about equity crowdfunding because of this emotional investment.
One last question, and then we're going to have to end the session. From Patrick, who asks, because there are a couple crowdfunding platforms out there, as a founder or to a founder, what would you recommend to prioritize, and what do you focus on? So location, industry focus, stage, investor type, etc.
Yeah. That's a tricky one. So I think the only advice that I will give is talk to all of them before you choose which one to work with. That's the only thing, because at the end of the day, it depends completely on the company and what they are looking for. One of them, for example, us at Crowdcube, I think the fact that we have an office that it's just focused on international companies, it's really good because we have a team that is focused on UK ones, but we have 6 people here who is focused on European ones. So that gives a lot of help, especially to Spanish entrepreneurs in this case. There will be some companies that will be interested in a feature that a platform is using, but the other one it's not. What you shouldn't do is just choose one after talking to that one. You have to talk to all of them. It's the only advice that I can give.
Thank you so much to the 3 of you for joining us. We're going to have to end the session right on time. We're going to have a 15-minute break. I think Alice is going to come back. I'm not entirely sure if she is, but if not, we're going to have a 15-minute break before our session with Bartosz. So Elven and AWS will be doing a session on the current fundraising landscape. And in the meantime, there's several things you can do. We have a booth talking about, because we have many French entrepreneurs here who are trying to figure out what's going on in public financing. So we have a 15-minute break before our session with Bartosz. So Elven and AWS will be doing a session on the current fundraising landscape. And in the meantime, there you go, because we were hearing myself with a lag. And then we'll be also doing a sort of networking session where you can all meet each other. Alice, there's a lag in your connection, so I'm gonna let you speak now.
Okay, cool. Can you hear me now?
Okay, bye everyone.
Yep. I'm Matthias.
Thank you.
Thank you,
Bye.
everybody. Thank you. It was a great moment.
Que la famille.